Today I'm talking about a cheap high growth stock that could 2x fast. And I'm not just saying that. It's a differentiated fintech stock, and it's not Upstart, it's not SoFi, and it's not Affirm. I initially covered a fintech stock called Upstart back in February, and it's up 397% since that video. I've been able to capture 279% of that move with my Upstart shares, but I think that this new stock in today's video could be like buying Upstart 7 months ago back in February. Let's do it. My name is Matthew, and today I want to introduce to you Lending Club, ticker LC. It's a fintech stock that has something Upstart and SoFi don't, at least not yet. It trades at a mere $3 billion market cap, which is just 1/10 of Upstart's value and 1/5 of SoFi's. However, it's growing just as fast as any other fintech, and it's trading at just 3 times its expected 2022 revenue of $1.09 billion. It has been literally half a year since I have bought a new stock in my portfolio. I've introduced many new companies to you guys along the way, stocks to watch and keep an eye on, but this is the first new stock I have bought since April of 2021. I am of course being very selective, so that means we have a lot to unpack in today's video. By the way, on Saturday, October 30th at 1 p.m. Eastern, I'm hosting a completely free webinar with all the investor community mentors. We'll be doing a complete top-down analysis of SoFi stock with fundamentals and technical analysis and Q&A, and we'll also have a lifetime discount promo code available for the investor community membership for the first 100 people to use the secret promo code that we'll reveal at the webinar. Down below in the pinned comment to sign up now. Again, it's completely free on October 30th, and you'll learn all about what a mentor session really is from investor community. In worst case, you get some free in-depth research on SoFi, which is, yes, a competitor to today's stock, which we're refocusing on, Lending Club. So we're going to dive into an overview of their business, a recent massive move that the company just made, then their financials and the valuation. So Lending Club, and I'll just call them the club for the rest of the video, is a very similar business to Upstart, but they have a different business model. They're similar in that Lending Club supplements traditional credit metrics with artificial intelligence that analyzes billions of cells of data points that they have been collecting since the company's founding in 2006, which is 6 years before Upstart was founded, by the way. With this information, they issue unsecured personal loans, usually to help people finance credit card debt, as well as pay big bills like medical patients. They also help with auto refinancing and lowering your monthly payments on your car. The personal loans originated by the club have recently outperformed their competitors, delivering a 35% lower delinquency rate. Right now, they generally serve people between a 600 and an 850 FICO score. And surprisingly, 50% of their customers will come back within 5 years. This tells me that not only do customers enjoy their product and they treat them well, but also more importantly on the financial side, their customer acquisition costs are probably a lot lower than their peers. Now we need to address the massive shift in their business that happened earlier this year in February. It seems to be a popular month this video. Lending Club has a horrendous performance since its IPO, trading down 72% since then. But as far as I'm concerned, this is a completely new company starting from this point right here. And that's because at that point in February of 2021, they closed on a crucial acquisition of Radius Bank. This gives them ownership of a chartered commercial bank. This national bank license that they received through the acquisition of Radius Bank is something that SoFi is still trying to get and Upstart currently lacks. I cannot emphasize enough just how important this chartered bank is for Lending Club, and I will explain in a second. It's absolutely huge. It leads to several net benefits for the company, and I implore you, I beg you to listen to all 5 of these. The first of which is cost savings. Being their own bank eliminates the need for Lending Club to rely on a third-party bank to fund their loans. This eliminates issuance fees and saves Lending Club $25 million annually. If that makes no sense, it's okay. In other words, before acquiring Radius, Lending Club needed a bank to help them create loans, and that cost money. But now, since they are their own bank with the Radius acquisition, they don't need the third-party bank anymore, and that saves them $25 million annually. Keep in mind, they got Radius for a $185 million acquisition. The second benefit of having Radius and this acquisition is recurring revenue. Being a bank, they can now also hold loans for investment on their own balance sheet. In other words, when they create loans, which they can now do independently, 80% of those loans they'll sell to institutional investors, and this is what they usually do. This is what makes up what's called their marketplace revenue. But the other 20% is new and crucial. This 20% is kept by the club for themselves, so they'll continue to collect interest on more and more loans. This is straight recurring revenue. This is already showing up in their financials in a major way. The light blue areas here on this chart represent net interest income. In other words, that light blue represents all the interest they're collecting from the loans that they now keep for themselves. The third benefit is simply higher earnings potential. Holding the loans on their balance sheet is 3 times more profitable than selling the loans. And that's directly from the CEO's mouth.
For every loan we hold, we earn 3 times as much as for the loans we sell.
The fourth benefit is that now they have an absolute goldmine for data. Radius Online Bank is now Lending Club Banking, which has a wide range of banking products and services, including high-yield savings accounts, rewards checking accounts, early direct deposit features, tailored checking, mobile wallets and payments, all of which are providing Lending Club with more data points for their risk models. And finally, fifth, pricing power and credibility when it comes to their loans buyers. Keeping 20% of their own loans on their balance sheet provides institutional investors much more confidence in the club's loans because they see LC is holding the same loans themselves. It's kind of like if a chef were to eat his own food to prove to the emperor that it's not poison. Lending Club holds their own loans on their balance sheet, which shows investors that they believe their risk model is strong and efficient and effective. Also, if the market isn't offering good prices for the loans that they want to sell, the club can just keep the loan for themselves and collect interest until conditions are more favorable. They have more price control now than ever. And that is why Lending Club is a completely different business than it was before 2021, and partially why I think it's such a strong fintech play. It now has a more resilient business model with recurring revenues from loans on its balance sheet, something that, again, can only be done with a chartered bank, all while collecting millions of data points from their millions of members from their current and future banking services and products. This will all help refine their AI and ML capabilities, which will allow their origination to expand to a wider audience of people, perhaps with lower credit ratings. That will just keep the wheels spinning. And not to mention the extremely lean operations because it's completely online, so there's no overhead for brick and mortar branches. And again, the elimination of third-party bank fees. As a reminder, the TAM, or total addressable market, is quite enormous for Lending Club and everyone else in the personal loans space, with $835 billion in credit card balances as of Q4 2020, and this is relevant because much of the club's personal loans are to finance credit card debt. The projected annual personal loan originations are expected to increase at 23% CAGR, or compound annual growth rate, and reach $47.9 billion in 2024. For context, Lending Club has done $60 billion in originations since they were founded 15 years ago, making them the market leader, but we'll probably see $50 billion in originations done cumulatively in one single year by 2025. To quickly touch on management, the original founder and CEO of Lending Club resigned way back in 2016 due to some shady activity, and he was replaced by Scott Sanborn, who I actually quite like after watching several interviews. Scott has been at Lending Club since 2010 and previously served as CMO, COO, and president. He's very forward-thinking and open-minded when it comes to technology, which of course is crucial in the fintech space. For example, he was discussing blockchain technology and smart contract technology in 2017, which shows me he won't fall behind like legacy banks have. Now, moving on to their financials, they absolutely blew their guidance out of the water in their most recent quarter, Q2 of 2021. For that quarter, they guided for $1.7 to $1.9 billion in originations and instead hit $2.7 billion. They expected $130 to $140 million in revenue and instead saw $204 million. They projected a sizable loss of negative $30 to $40 million and instead came out GAAP profitable. Now, if we take a look at their income statement, it can get a bit complicated, so I'll do a brief rundown. Up top is non-interest income, which is exactly what it sounds like. Income that is not from the collection of interest. This would include marketplace revenue, which is the origination fees and sales of loans they've originated. This represents the bulk of their total revenues. In Q2 of 2021, they saw $158.4 million in total non-interest income. Then there's interest income, which includes the interest from loans that they are currently holding, both the ones that are still up for sale and the ones that they intend to keep on their balance sheet. This interest income isn't free though. You see, they have to fund those loans somehow because they no longer have that third-party bank to help them anymore. Remember? So, Interest expense accounts for things like interest on deposits that they pay to their customers who have money in checking and savings accounts. So anyone in the banking industry, please correct me if I'm wrong, but I'm under the understanding that the deposits in checking and savings accounts, that's the money that helps fund their loans, so it is subtracted from their interest income. And that works because they pay out a lower interest than they're receiving on the money they loan out. So that is how we get net interest income of $45 million. Add that to the non-interest income above, and you get a total revenue of $204 million for Q2 of 2021. And this translated to net income of $9.6 million on the bottom line, their first quarter of GAAP profitability in a while, but a huge step in the right direction, of course. Now, yes, their margins might look slim right now, especially when compared to the higher margins and more consistent profitable margins of Upstart. However, I believe that over the long term, this recurring revenue model with the interest and loans on their balance sheet will lead to a much more profitable business in years to come. But all that math needs to be broken down in another video, so make sure to subscribe if you haven't already, and toss a like if you're enjoying the video so far. These videos take a really long time to research, record, and edit, so that's all I ask for you. Thank you so much. Now, on the topic of Upstart, I want to compare Upstart and LC's revenue growth head to head. This table I'm about to show you was heavily inspired by a great Seeking Alpha article comparing Upstart and LC, so I want to give credit to that. But I did add some growth rates and, of course, 2022 projections. So this compares Upstart and LC's loan origination and transaction volume, as well as their revenues and projected revenues. And when you look at it, you'll realize that Lending Club is actually growing faster quarter over quarter, and they're expected to grow at almost exactly the same rate to almost the exact same revenue in 2022. Yet Lending Club trades at 1/10 the value of Upstart. Now, as we move into valuation, there's only a couple reasons why I can explain Upstart's 10x premium to Lending Club. First is that Lending Club has done a terrible job of explaining the sexiness of their artificial intelligence, whereas Upstart has done an amazing job of using as many buzzwords as possible. Now, no hate to Upstart, I own the stock, but I just think that Wall Street has given a lot more attention to them because of the way they're marketing themselves as a business model and investment. You see, Upstart has boasted an 8-year head start on collecting data for their artificial intelligence model, but Lending Club, as I've said before in this video, was started in 2006 and started collecting data 15 years ago, almost double the current lifetime of Upstart. And the second reason is maybe because Upstart's margins are currently stronger, as I mentioned before, but again, I think that's more of a near-term thing, and we'll see Lending Club's margins catch up at least, if not surpass Upstart's. But right now, the premium for better margins is valid, but I don't know if it's 10x valid. So I put together a tiny, not comprehensive comps table that still has many metrics that should and could eventually be added. But strictly on an enterprise value to next 12 months projected revenue basis, I wanted to compare these 4 companies. Now remember, enterprise value accounts for cash and debt instead of just the market cap, and next 12 months revenue is projections for 1 year forward because we're looking at growth companies, so we want to look into the future. I didn't use profitability metrics yet since these companies are all in growth mode and some are not yet even profitable. We can clearly see though that Lending Club trades at 3.8 times next 12 months EV to revenue, which is a significant discount to every other stock on the list. Upstart trades at 32 times next 12 months EV to revenue, despite the similarities in revenue growth that we pointed out earlier. Now, on the bright side for you SoFi investors, I could see how one would argue that it is fairly valued today. And by the way, reminder that full SoFi analysis for free webinar end of this month, October 30th, Saturday, 1 p.m. Eastern, with all the investor community mentors and live Q&A and lifetime discount promo code. Make sure to sign up below, but back to the comps table. So in terms of projected revenue for 2022, Affirm takes the cake with the highest projected revenues, and SoFi is expected to see the highest growth rate in 2022 at 50% plus. But all in all, I have kind of a hard time wrapping my head around the fact that Lending Club looks so incredibly cheap when it's one of the only 2 profitable companies on this list. It's expected to do over $1 billion in revenue in 2022, and its growth rate is keeping up with the other companies. So what am I going to do? Well, actually, recently I let everyone in the investor community know in real time with my reasoning that I actually opened a position in Lending Club with 1% of my current portfolio. I could see this becoming a 5% position in my portfolio as I continue to do more research, but this is what I call a feeler position. So I'm continuing to do the remaining 10% of my due diligence, and if everything checks out, I'll continue to keep buying. Now, one important thing to note is that they do have earnings coming up on October 27th. This upcoming quarter quarter could be a tough one to digest for the market, and we could see a violent reaction downwards potentially. Now, I'm not saying it's going to happen, but there is an accounting standard called CECL, C-E-C-L, which stands for Current Expected Credit Loss, I think. Yep, current expected credit losses. And it's an accounting method that could disproportionately impact lending clubs' earnings in the near term. Essentially, what I'm trying to say is that this accounting methodology could make their earnings look worse than they actually are. It's a non-cash expense that they have to recognize up front when taking on all of these new loans onto their balance sheet because they are now a newly chartered bank. And if that made no sense, what I'm trying to say is that I'm looking at this next quarter as a potential buying opportunity if it goes down, because if it does go down, I have a feeling I will know why. But I'm also buying shares before the earnings report because I like the company where it's at and I'm not going to try and time anything. Let me be very clear, I am not timing earnings. I am buying so I have skin in the game to the upside, and I'm buying more if it drops after earnings. Obviously, this is not financial advice. Always do your own research, and I will continue to do mine. And if I find something that's a really big red flag and I abort this plan, first I'll let you guys know and I'll let everyone in the investor community know, but I don't think that's going to happen after the research I've done so far. I also think that this could be a really interesting hedge on rising inflation rates. Not only is this company beginning to be profitable, and I think it will continue to be profitable, which is much better than the loss-making growth companies that will probably get hit pretty hard if interest rates rise, but in general, rising interest rates is good for companies that are issuing loans like Lending Club, like Upstart, like the others. Make sure to download the new financial app I'm working on, Hungry Bowl, down below in the description, and also sign up for that free webinar at the end of the month. I'll see you there. Subscribe.